All right, everyone. Bismillahirrahmanirrahim. Assalamu alaikum, everyone. My name is Yasir Yamin, and I welcome you all in this session. In today's session, we'll be doing one past paper on, preparation of financial statements. This is a past paper, Loudon Company, and we'll be, inshallah, doing this question very well. If you look at the mark allocation of this question, this is a complete 20 mark question in which you need to prepare a schedule of adjustments which are required on retained earnings in order to get it ready as at 30th September 20x8. And plus, you need to prepare a full statement of financial position of Loudon Company as at the year end. Now, this is a full 20 mark question. And since we are practicing right now, we need to make sure that we go by the time. So I'll try to be a bit more quicker just to make sure that we stay within the stipulated timelines. All right. But at any point in time, if you feel that I'm going too fast, or if you feel that you don't understand anything, you need to inform me about it on a prompt basis so I can repeat accordingly. All right. So if I were you, I would start a timer with me. 1.8 minutes into 20 marks is approximately 36 minutes. So we'll try to close this by 36 minutes, or maybe, take a 5 or 10 minutes more because I'm going to explain you some stuff, but not more than that. All right. So that's our objective. We'll start with it. It says Loudon Company has prepared a draft statement of profit or loss for the year ended 30th September 20x8. Remember, if your year end is 30th September 20x8, then your year start must be 1st of October 20x7. So you have been given with a, Loudon Company actually prepared a draft statement of profit or loss before any adjustments that, that are required in notes 1 to 4 below. The draft profit has been added to retained earnings. So you see retained earnings of 4122 in your trial balance, and within this retained earning for the year profitability has already been included, but that profitability does not include the impacts which are going to be discussed in notes 1 till 4 below. So the draft profit has been added to retained earnings, and the summarized trial balance of Loudon Company as at 30th September 20x8 is as follows. So you've been given with a trial balance, a draft trial balance, and you need to make sure that you complete, you prepare a schedule of adjustments for retained earnings and complete the question in its entirety. If you look at the trial balance, you first have been given with equity share capital of $1, $10,000 in thousands. So $10,000 is your share capital. Par value is $1, so that equates to 10,000 shares. Then you have been given with draft. I would call it draft retained earnings as at the closing date, which is 4122. Remember, this is draft. It needs to be adjusted by you. Then you have been given the cost of office building, which is 20,000. You have been given cost of factories, which is a non-current asset, as at 1st October X7, which is 40,000. Then you have been given accumulated depreciation on office building of 4,000, factory accumulated depreciation of 11,100. Then there is something known as environmental provision as at 1st October X7, which is the start of the year. So you have made some environmental provision in your books of 1st October X7, and the opening balance, 1st October 20x7, opening balance of this provision is 1228. Then there are cumulative current liabilities given of 34,500, current assets given of 14,700. Then there are some proceeds of loan notes. So the loan note itself has a value of 5,000 and there is an interest rate on it of 5%. There is a deferred tax balance given on the credit side of the trial balance, which is 1,500. Remember, guys, if a credit side balance of deferred tax is given, then it must be a deferred tax liability. A liability is of credit nature, and that is why if a credit balance is given, it should be a liability. Make sense? Then there is some interest paid, which is of 250. If I make a wild guess, then it's fairly obvious rather. $5,000 is the loan note value and 5% is the interest rate. So 5,000 into 5% is 250 worth of interest which has been paid during the year. Suspense account is 3,500, and you and I both know that a suspense account is never acceptable. So we need to clarify, we need to eliminate this suspense account as well while we are solving notes 1 till 4 below. All right. I'll reiterate what I always say. Remember, if you are going to become a very good chartered accountant, you always need to go through the trial balance first. I've seen many students, what they do, they will skip this part, the whole question part, because they are aiming to solve the question very quickly. They want to do this question within 15 or 20 minutes. They think like they can do that, and they just skip the initial information, directly go onto the notes and try to complete the question. But often what they do, in by skipping the whole trial balance, they skip the core concepts of the question itself. All right. So you do a lot of mistakes while actually solving. It's seldom would be the case whereby a student foregoes, skips all the information which has already been given in the trial balance, does not analyze that information, and still scores good marks. I never recommend that. Always go through the trial balance first, then with patience go for each and every note separately. Inshallah, everything will be fine. So you read the loan note. The first note is about loan notes. It says a 5% loan note was issued on 1st of October 2007, which is the start of the year, at its face value of $5 million. So what I'm writing here is we are doing working number one, and this working number one is going to be all about loan notes. So there is some loan note which has face value of 5 million, or in thousands, I would say it has face value of 5,000. Examiner says direct cost of the issue amounted to 0.125 million or 125, and these were charged to profit or loss. Guys, see, as far as the issue cost is concerned, the original entry, the original entry which is supposed to be made in the cases of financial liability for issue cost is supposed to be. IFRS 9 says that, the impact of issue cost is always included within the effective rate of interest. And therefore, any issue cost that you see upfront, any issue cost that you see at the issue of the loan note must be capitalized. It must be initially capitalized within the loan value, and then it is amortized over the period of time as a loan related cost through the use of effective rate. So originally the accounting entry for any type of issue cost that arises during the issue of loan note is supposed to be, you credit your cash, obviously you're paying out something, so you credit cash, and the debit is not P&L. The debit is not P&L. You always debit your loan liability. You always debit your loan, right? So it's 1 to 5 loan debit and cash credit. But you see what your accountant has done. Accountant's entry I'll talk about. Your accountant has rather made this accounting entry. He must have credited cash. That part is right. But these 1 to 5 costs were charged to P&L. So they charged off it to P&L. So P&L debit 1 to 5 and cash credit 1 to 5. Now, this is definitely not the correct entry. This is definitely not the correct entry. Correct entry is to capitalize, this issue cost against the loan value. Loans should be debited. What would be the correcting entry if I must ask you? The correcting entry should be that loan was supposed to be debited, but it was never done by the accountant. So we will do it. Loan debit 1 to 5. And moreover, cash was supposed to be credited or bank was supposed to be credited. We will be crediting, sorry. Rather, P&L was never supposed to be debited, I would say. P&L was never supposed to be debited. And in order to reverse that impact, we will credit our P&L. Understood? So while we are correcting what accountant has done, we will have to take a credit to our P&L Or in other words, I would say I'll have to increase my profit. Or in other words, I'll have to say I will have to increase my retained earnings during schedule of adjustments. And furthermore, I'll have to adjust this issue cost against my liability. So issue cost will be a decrease in liability value, and therefore my issue value of the loan note should be this. All right. I always told you while we were doing IFRS 9, there are four important things when you have a liability which is carried under amortized cost model. Face value, issue value. What were the two other things, if anyone could remember? Do you guys remember what were the other two things that we always used to require? I've just given you a hint. Coupon rate, yes, and effective rate. So we need to at least find two more things into the question. Examiner says the loan will be redeemed in 5 years' time at a substantial premium, which gives it an effective rate of interest of 8%. The annual repayments of 250,000, as were the case here, the annual repayments of 250,000, which is 5% on face value, are paid on 30th September each year. So the coupon rate is 5%. Now we can just convert these values into percentage. Make sense? All good? So now we have four things available with us: issue value, face value, coupon rate, effective rate. Now, what do we do? What do we do? We prepare a amortization schedule, right? How do you prepare an amortization schedule? There are four columns involved: date, amortized cost brought forward, interest expense, interest paid, and also amortized cost carried forward, right? So there are five columns to the amortized cost schedule. All right. Now I'll start with day one. Remember, story always starts from day one. This loan was issued on 1st of October 20x7. So the first date is 1st October 20x7. At this date, there was no brought forward, no interest expense, nothing was paid, but still our liability value at that date due to the issue of loan notes was supposed to be 4875. And this is after adjustment of issue cost. 1 year after, which is the year end, 30th September 20x8, still our opening balance would be previous period's closing balance. We'll be calculating interest expense on our liability amount at the effective rate, which is 8%. So interest expense should be 390. At the same time, our interest paid should be 250, which is 5,000 into 5%, which is 5,000 into 5%. And we would calculate a closing liability value like this, which is 5015. Is everybody clear about this 5015? Please confirm. Are you guys clear on this 5015? How do I calculate this? Your closing liability will include the unpaid amount of cost of loan. So our interest expense is 390. Out of that, we only pay 250. The remaining that we don't pay now, we still will have to settle the other party one day or the other. And therefore, that will become part of our closing liability. Our closing liability should be 5015. Our loan is going to be redeemed at a substantial premium. So our liability needs to be updated, each and every year to account for that premium. All right. What should be the accounting entry for this year? If somebody asks you what would be the accounting entry, the accounting entry should be we paid cash, so cash credit 250. On the other hand, interest expense would be debited by 390. So 390 goes into P&L or is rather taken into schedule of adjustments against retained earning as an expense. And the remaining part should be part of your financial liability, if I may call it. Yeah. So the balance is financial liability. We'll have to settle it one day or the other. All right. So interest expense is an additional amount that we take into our schedule of adjustments. All right. Is it clear to everybody? Give me a Y or an N, or give me a yes or a no. Very good. Excellent. So at least we are done with working number one. Let's move forward. Non-current assets we are going to talk about now. So it says Loudon Company. By the way, we had two types of non-current assets. We had some office buildings, if you see, right? We had some office buildings. And then we also had some factories, right? So we have two things. I think the question is going to talk about both non-current assets. Examiner says Loudon Company acquired an office building for $20 million on 1st of October 20x2, many years back, with an estimated useful life of 25 years. So right now, what we are doing is we are doing working number 2, which relates to non-current assets. And under non-current assets, in particular, we are talking about office buildings, right? So we have an office building whose cost is 20,000 or 20 million, and it has a useful life of 25 years, right? So if useful life is 25 years, depreciation per annum should be 20,000 divided by 25 years, depreciation per annum should be 800. Make sense? Examiner says depreciation is charged on a pro rata basis. It says on 1st of April 20x8. Now, guys, you guys are very smart. Our accounting year starts on 1st October 20x7, ends on 30th September x8, and they are talking about a particular date which is 1st April 20x8. Can I say 1st April 20x8 lies in between these two dates? It lies between these two dates. And factually speaking, this actually lies exactly between these two dates. So it's mid of the year, right? So 1st April x8 is actually mid of the year. Make sense? All right. So they say on 1st of April 20x8, mid of the year, the building was deemed to be impaired as its recoverable amount was estimated to be $12 million. So it's clear. It was deemed to be impaired, so you must have performed some impairment testing and you might have seen some impairment charge as well. Why don't we do that stuff? I mean, you have an office building whose cost was 20,000 on 1st October 20x2, many years back. If I subtract some accumulated depreciation, and I'll go with a particular pattern. First, I'm going to subtract accumulated depreciation till 1st October x7, which is till the start of the year. So from 1st October x2 till 1st October x7, how many years have passed? X3 1 year, x4, x5, x6, x7. So we bought this office building on 1st of October x2 till 1st of October x7, which is start of this year. 5 years have passed. 5 years have passed. So technically speaking, at the start of the year, our accumulated depreciation would be multiplied by 5, 4,000. Yeah. So our net book value at 1st of October x7 at the start of the year would be 16,000. Do you guys all agree? Done? Yeah. Then let's go step by step. We heard about some impairments 6 months down the year. So let's just first pass, first let's get pass through the first 6 months. I will write here 6 months depreciation. 6 months depreciation, I would say, should be half of 800. So I'll just divide it by 2, 400. And by the way, this 6 months depreciation represents this year's 6 months depreciation. So this definitely goes into P&L. I have a common habit of highlighting all the adjustments that are to be done within your P&L. It's always good to highlight with a certain color all your incomes or expenses so you can easily recall what needs to be adjusted while you're working on the final P&L. All right, so highlight those. So technically speaking, my net book value on 1st April x8 would be 15,600. And at this date, we performed some impairment test because our asset was deemed to be impaired. Carrying value, or rather I can just copy it, net book value at 1st April 20x8 was supposed to be 15,600. And against this, examiner gave us a ready-made recoverable amount of 12 million. Otherwise, recoverable amount is higher of fair value less cost to sell or value in use. But otherwise, our examiner gave us recoverable amount ready-made. Our recoverable amount is 12,000. So how much impairment loss you get? Remember, impairment is said to arise when your carrying value exceeds your recoverable amount. Here, your carrying value exceeds your recoverable amount by 3,600. So you definitely have an impairment loss of 3,600, which should also be written off against your profit. Make sense? Which should also be written off against your profit, right? So right now, if we logically see carrying value, which should be there after impairment on 1st April 20x7, that should be 15,600 minus impairment loss of 3,600. So our carrying value after impairment should equal to the recoverable amount, which is 12,000. Examiner says at that date, the estimated remaining life was revised to 12 years. You can ignore any deferred tax consequences on this revaluation. We would have ignored it in any case. As a student, you would not even remember what deferred tax on revaluation is, right? So you're thinking right now, why is examiner writing just ignore deferred tax on this revaluation? I didn't even get this in my mind. Huh? Still, your examiner ensures completeness and it's saying, no, don't worry about any deferred taxation on revaluation. Students are saying, we don't even remember that. Why are you saying forget it? I don't even remember that, right? Nevertheless, so carrying value after impairment is 12,000. If we calculate last 6 months depreciation, how should it be calculated? Any ideas? Once there is something unusual within your financial statements, within your accounting, within your reporting, how do you calculate your revised depreciation? You take your revised carrying value and you divide it by your remaining useful life. You divide it by your remaining useful life. So how do you do that? You take 12,000 divided by remaining life of 12 years. But remember, Nadeem, remember, it's just 6 months. All right. So multiplied by 6 divided by 12, it's just 500. And this 500, by the way, should be written off against your P&L. Finally, if I may ask you that what should be your net book value? What should be your net book value at 30th September 20x8, which should be written in your SOFP? It should be 11,500. Make sense? Is it good with everyone? If I ask you what should be the total expense on office buildings, what should be the total expense on office buildings? What should it be? I think you will be considering this 400, right? The first 6 months depreciation, the last 6 months depreciation of 500, and plus this impairment. So everything goes into P&L, right? So this 4,500 actually goes into P&L. Is it okay? Are you guys good with this? Everyone? Excellent. Let's move forward. We still, we need to save time. Let's go for the other part. It says Loudon Company had 10 factories, the other non-current asset. On 1st of October 20x7, which is the start of this year, Loudon Company sold one of its factories with a carrying amount of 3,000 for 3.5 million. For 3.5 million. The only entry made in respect of this disposal is for the proceeds. The other part has been credited to suspense. Now you see what's happening. We are actually talking about a factory, right? There was a factory building, maybe, whose carrying value, it's clearly written, its carrying amount was 3,000. And we sold this for a disposal proceed of 3,500, right? So there must be a gain on disposal. There must be a gain on disposal of 500, right? And this 500, by the way, this 500 goes into your P&L or as an adjustment to retained earnings. Make sense? But what they are saying is examiner has credited the impact of this disposal in a suspense account. And here we can see the credit balance of this suspense account. They haven't done anything about this disposal. They have just credited the accounting entry, just the balance of the accounting entry under a suspense account. Now, definitely this suspense account needs to be reversed. So if I were to ask you what should be the correcting entry for this transaction, I would say that for sure, suspense account will be a debit of 3,500. That part is pretty much clear. But I ask you what should be credited to account for this disposal correctly? What should be credited, if anybody could tell me? You have just disposed of a factory whose carrying value was 3,000. You sold it at a profit of 500. So credit should be factory net book value credit 3,000. And there must be a gain on disposal. So this should go into your P&L 500. Is everybody clear with this? Remember, making accounting entries is not a requirement for your exam. You are not required to prepare accounting entries, but just for the sake of clarity and understanding, if you want to prepare accounting entries, you won't get any extra marks for it. But still, if you want to do that, you can do that. There will be no deduction because you just made accounting entries. Are you guys good with this? Is everybody clear about this? Right? So this is how you eliminate the suspense account in its entirety. Examiner says no depreciation has yet been charged on any non-current asset for the year. The factories are depreciated at 15% per annum using the RBM method. So now we need to have some depreciation on factory, right? And you need to do this depreciation based on reducing balance method. How would you do that? How would you do that? So technically speaking, whenever you're talking about reducing balance method, you apply percentage on net book value, right? So if you go into your trial balance, your factories have a total cost of 40,000. So writing 40,000 here, you can see this. Then you have an accumulated depreciation already till the start of the year of 11,100, right? But remember, this is before the disposal was accounted for. If you account for the disposal, 3,000 further would be separated. 3,000 further would be separated because you have just disposed of an item with a carrying value of 3,000. Do you all agree? Right? And whatever is remaining, you will apply 15% on it. Make sense? So the outcome of that should be there would be a depreciation charge of 3,885. Is it clear to everybody? What I have done is I've just taken the net book value, subtracted further 3,000 from it because there was a disposal and applied 15%. No rocket science in it. Make sense? All right. So we are good with it. Remember, this gain on disposal goes into P&L. This depreciation goes into P&L. All right. If I were to ask you what should be the carrying value of factory in SOFP? Can anybody tell me what should be the carrying value of factory in SOFP? If I could ask you. The initial cost was 40,000, accumulated depreciation was 11,100. We disposed of an item with a net book value of 3,000, and after that we have further depreciation of 3,885. So our closing carrying value of factory, which should go into our SOFP, should be 22,015. Is it clear to everybody? Is it clear to everybody? For our for our office building, for our office building, the net book value was supposed to be 11,500, and for our factory, it is supposed to be 22,015. Is it clear to everybody? Done. Now we are done with non-current assets as well. Definitely the largest note which was available in this question. Now let's move on to working number 3. right? We've already spent a lot of time. Environmental provision. Remember, there was a trial balance value of environmental provision of 1228, which was based on 1st October 2007. A liability was already there in your trial balance. Examiner says, Loudon Company has an obligation to clean up the environmental damage caused at one of its factory sites during 20X7. The cleanup is due to take place at the end of factory's useful life. Do you remember this case some way or the other? Isn't this a similar case which we have studied in a particular accounting standard? So you are doing something and you are damaging the environment, and you will have to clean up that particular site after the end of useful life. What is this? Yes, I-16 compulsory disposal cost. I've already heard about it. And how did you resolve for compulsory disposal cost? It was a future cost that was to occur after 5 years, 10 years, 15 years, 20 years, whatever. You will have to estimate that cost at that point in time, calculate its present value, and recognize a liability. And other than each and every year, you will have to recognize an unwinding of discount as well. Remember? All right. So this is how you deal with environmental provisions, right? Examiner is saying the cleanup is due to take place at the end of factory's useful life. The liability has been accounted for appropriately, and the balance at 1st October 20X7 represents the correct present value at that date. So examiner is saying we have already calculated the present value, and whatever you see in the trial balance, whatever you see in the trial balance is the correct present value. They have done everything as far as the present value is concerned. So they would have made an accounting entry, property, plant and equipment debit, and environmental provision liability credit. As far as that portion is concerned, everything has been done correctly. But this was at the start of the year. Examiner is saying Loudon Company has a cost of capital of 5%. Can you tell me what our examiner is expecting us to do? If they had already accounted for the accounting entry appropriately, what do we have to do at the year end? And I just mentioned about it, a while ago. What we need to do. Yes, Abdurrahman, we need to recognize an unwinding. So I'll write unwinding of discount here. What do we do? 1228 is the liability value. We multiply it by 0.05, or what you call 5%. So 1228 multiplied by 0.05, this is 61. This is 61. Make sense? And by the way, this 61 is also going to be charged off against our profit, right? So I'll use the same color. We are done with this one as well. So the last working maybe, working number 4. And it's all about deferred taxation. So let me call it deferred tax, right? It's deferred tax. They are saying at 30th September 2008, which is the closing date, the tax written down value, or tax WDV, or tax base of property, plant and equipment was $25 million. The income tax rate applicable on Loudon Company is 20%. Do you remember how do we used to calculate deferred taxation? In order to determine deferred taxation, we always used to have 3 columns, right? One was our carrying value, or book value, what you call, right? Then the other one was tax base, and then we used to have some temporary difference, right? We remember this, right? Now they are telling us that the tax base of PP&E is 25,000. But only this information does not solve our problem, right? We need carrying value of our property, plant and equipment as well, in order to determine if there is a temporary difference or not. Can anybody tell me how should I be calculating carrying value of my property, plant, and equipment? How should I determine this? Any idea? Oh, very good. Oh, very good. You're right. I will take the net book value, the closing net book value. Remember, we are determining deferred tax liability or an asset at the end of the year. So at the end of the year, the net book value of my property, of my office building is 11,500. We already had determined it earlier. And for my factory, it's 22015. We had already determined this as well earlier. So the closing balance of our property, plant, and equipment should be 33,515. We compare it with the tax base of 25,000. There is definitely a difference between our value and tax people's value. And whenever your carrying value is higher than your tax base, it is supposed to be your taxable temporary difference. And everybody knows that whenever you multiply your taxable temporary difference with the tax rate, which is 20% in this case, let me turn it into a percentage. Yeah. You get deferred tax liability. So if you think about it, deferred tax liability at 30th September 20x8, which is the closing date, your deferred tax liability at the closing date should be 1703, and this should go into your SOFP. Yeah. But remember, I always used to tell you, always compare your closing deferred tax liability with your opening deferred tax liability in order to understand the change during the period. Now, if I would take your opening deferred tax liability, let's go in the trial balance and see if there was any. Yes, I can see it. So the opening balance of your deferred tax liability, guys, is 1500. It's 1500. So opening is 1500. And technically, there is an increase in your deferred tax liability of 203. What should be the accounting entry for this increase in your liability? Think with common sense. Your deferred tax liability will increase, hence it will be credited by 203. And there will be a corresponding adjustment to your P&L. So P&L debit 203. Agreed? And this 203 as a tax charge would be written off against your P&L. Does everybody agree with this? Does everybody agree with this? Yeah? Excellent, guys. Now, guys, we are done with this. And now our requirement is to prepare a schedule of adjustments required to the retained earnings of Loudon Company as a result of the information which is given in notes 1 till 4, and then we prepare an SOFP. So I'll make a sub space for myself, right? So let me just expand this a bit. Yeah. So answering part A, I will be preparing a schedule of adjustments to retain earnings as at 30th September 20x8. Yeah. Hmm? Our draft retained earnings, as given in the question, are 4122. You can see this into the question 4122. And there will be some adjustments required, right? What are the adjustments required? If I were you in the examination, first I will write down all the adjustments, descriptively. Let's see. First, there was the case of issue cost, if you remember it correctly. Luckily, we had highlighted everything. So first, there was the case of issue cost. Then there was a case of some interest expense, right? Then there was some expense on office buildings, right? So total expense on office buildings, right? If we move forward, yes, there was a gain on disposal on factory, and then there was depreciation on factory. I'll write it down. Gain on disposal of factory, and then there was depreciation on remaining factories, right? Moving forward, there was unwinding of discount, then there was deferred taxation, right? Unwinding of discount, and then there was deferred taxation, right? So let's start adjusting everything. Issue cost. Remember, examiner had charged issue cost directly to P&L as an expense, and we had to reverse it. We had to reverse that expense. So I think this will be a positive adjustment to your retained earnings. I'll write it as a positive is equals to link. Try to link everything with your working. If you do that, it's a plus sign. If you don't do that, that's fine. But still, I would certainly recommend that you try to link your paper so that your examiner can easily trace out and provide you good marks. So 125. Interest expense, it should be a dilution of your profit, recognizing an expense. So minus 390, right? Then there is an expense on office building. Again, it should be a minus. So total expense on our office buildings, total expense on our office buildings was 4,500. Yeah. Then there was a gain on disposal, a positive thing, 500. Then there was depreciation on factory, just tracing out everything, whatever we discussed right now, 3,885. Unwinding of discount, which was 61. Yeah. And then there was increase in deferred tax liability or deferred taxation, which was 203. Make sense? So cumulatively, we have to make adjustments of 8414. And when we do these adjustments into our draft retained earnings of 4122, netting this off with 8414, there will be a retained loss balance as at 30th September 20x8. We went into retained losses, I think primarily because of an impairment charge, high depreciation on factories and poor performance. Make sense? All right. And when we are done with this, the last part is part B. We need to prepare an SOFP as at 30th September 20x8. You start your SOFP with assets, and under assets, you take non-current assets first, right? Under non-current assets, your first non-current asset should be property, plant, and equipment. Yeah. If you remember correctly, we had already calculated the total closing value of our property, plant, and equipment. Yeah, right? We were doing something for deferred taxation, and we had already calculated the closing value of our property, plant, and equipment, which was a sum of these two numbers, 11,500 and 22,015. The closing value was 3315. Make sense? 33515, right? We have no other non-current assets. There is no goodwill or anything like this, no intangible assets. Done. Property, plant, and equipment done. If you don't have any other non-current assets, I think we should be going for current assets. If you, yes, closely look at the trial balance, current assets are given as a cumulative balance of 14,700. So 14,700. And then our total assets would be 33515, 14,700. Our total assets are 48215. Clear to everyone? Is everybody on the same page? Yeah, very good. And then let's go for equity and liabilities. Equity and liabilities, right? So equities and liabilities, first we'll go for equity. Under equity, first of all, we have some ordinary share capital, right? Then we have some retained losses rather. Ordinary share capital, you can see it's 10,000. No further shares issued during the year. There are retained losses, which we just calculated as a result of schedule of adjustments. It's 4292, right? So there is total equity, still positive equity of 5708, right? Then you talk about non-current liabilities. When you talk about non-current liabilities, as far as I remember, one non-current liability was your loan notes. The value of your loan notes should be this 5015. Remember, we worked it out through the amortized cost schedule, right? 5015. And then there must be, is there any other non-current liability into the question? Is there any? I mean, yes, there is deferred taxation. Then there is environmental provision. Environmental provision should also be your non-current liability because this amount will be payable at the end of asset's useful life. So it's a non-current liability for sure. So this should be deferred tax, right? And then some environmental provision, right? The closing value of your deferred tax was 1703, right? 1703. What should be the closing balance of your environmental provision? If anybody could tell me, what should be the closing balance of your environmental provision? I think at the start of the year, our environmental provision liability was 1228, was 1228. But yes, it will increase due to unwinding of discount. Yeah, taking current periods impact into our liability as well. So 61, incorporating that, it should be 1289. So our total non-current liabilities equate to 8007. And then we are only left with current liabilities. And if we go for current liabilities are ready-made given to us of 34,500. Let's write them down. 34,500. So I think total equity and liabilities should equal to 48215, and that is a perfect match. Is it clear to everybody? Let me have your feedback. Is this clear to everybody? Feedbacks are always welcomed.